Good afternoon, everyone, and thank you for joining us for today's quarterly market investment updates. I'm sure many of you have been with us before, so for those of you who are joining us for the first time, a special welcome to you. We have been hosting these quarterly updates since about 2020, I think, so it's been a couple years. This is a 1-hour session that's being hosted by May Barnhart Investments, the wealth management subsidiary of Counselor Buchanan and Mitchell, and our presenters are Debbie May and Alex Seleznev. So I'm going to read a couple of short bios, move on to some housekeeping items, and then introduce the speakers. So Debbie is a co-founder and chief investment officer of MBI and also a partner at CBM. She has 35 years of experience providing comprehensive financial planning and nearly 30 years of providing investment advisory services. She is a certified public accountant, a certified financial planner professional, and a certified divorce financial analyst. Debbie has been recognized 9 times by Washingtonian Magazine for her financial advisory expertise throughout the DC metro area. And she was also recognized within the last couple of weeks, I believe, as a top financial advisor by Bethesda Magazine. So you'll see that little logo there on the cover slide right now. That's relatively new. Alex Seleznev is a partner and a director of wealth management and financial planning services at CBM, and he's also a co-founder of MBI. He has 15 years of experience providing comprehensive financial planning and investment advisory services. He's a certified financial planner and a chartered financial analyst who leads the firm's investment management group. He is also a regular presenter for the firm, including at an upcoming session on pre and post-retirement planning. That's on November 17th. And there's also another session on Medicare and the Inflation Reduction Act on December 15th. So we hope you'll join us for those. Alex was also recognized as a top financial advisor by Bethesda Magazine, and he is frequently quoted in financial media outlets such as Kiplinger. I think his last quote was about a month or so ago. We will be offering CPE for those of you who are participating and are interested in it. I'm going to launch a sample poll now. So we'll be launching 4 of these polls throughout the next hour. They'll appear either on your the meeting screen or in the chat box. So just click submit for at least 3 of these, and then you should be good to go in terms of getting CPE. We'll issue the certificates within the next week or 2 after the session. Thank you for those of you who submitted questions during the registration process. Those have been shared with Debbie and Alex. And please feel free to use the chat box throughout the presentation, and they'll answer your questions. This session is being recorded. And finally, Alex, do you want me to read the learning objectives too?
We'll leave that up to you, Joe.
All right, there we go. And so the learning objectives, which we have to do for CPE compliance, is for those of you attending, you will be learning how market conditions are impacting investment performance and investor sentiments. You will learn about the impact of current events such as inflation, conflict in Eastern Europe, and other current events, how they're impacting investor buying and selling decisions. You'll be learning about short and long-term investment strategies in response to current events. And finally, you'll also have a chance to learn financial planning ideas to consider in the future, including Roth IRAs, tax loss harvesting, withholdings, and others. So with that, I'd like to welcome you again, and I will turn this over now to Alex and Debbie.
Well, thank you. Thank you, Joe. And
thank you.
Again, thanks everyone for joining us today. And as always, what I do prior to this webinar is I look at the list of attendees. We actually have quite a few of our existing clients in this webinar. That's great. I appreciate you attending our webinars. And also quite a few new names, people that I'm personally not familiar with. So also welcome. And for those of you who are less familiar with us, well, MBI, we're a comprehensive financial planning investment advisory firm. We're a fee-only firm. We always serve as a fiduciary when we work with our clients, and we're fully independent. So we can really customize your financial plan and your investment strategy for your specific needs. We have 7 people at this point who are dedicated to this type of work. We have 4 advisors or 3 analysts. We have 5 certified financial planners, almost 2 chartered financial analysts in our team, and of course, more than 40 CPAs as part of CBM. If you want to learn more about what we do, feel free to reach out to Debbie or myself or anyone else in our team, or simply visit our website on the bottom of this page. And with that, we'll get started. Usually in our quarterly market updates, we try to start with something that is, funny, or maybe not all that funny, but at least current. So inflation, of course, that will likely be the theme of the year. That's what 2022 will likely be remembered for, at least at this point. So is inflation something that you can ignore? Well, yes, you can ignore it as long as you never try to buy anything. So that's really the basis for this little joke. Interesting enough, we actually have several of our clients, in our meetings. They basically mentioned, look, it doesn't really bother us all that much. We don't necessarily buy all that much. We don't travel, and that's fine. But of course, for most people, it's a pretty big issue, and my assumption for many people in this webinar as well. So we'll certainly be covering that in detail today. In terms of our structure, as usual, we'll talk about the markets. We'll share some of our top ideas. We'll talk about some financial planning ideas as well. And we actually have a good list of questions to cover at the end of the webinar. And please, if you have any questions as we go, type them in the chat box. We will read those questions out loud. We'll address them either throughout the webinar or at the end of it, but we will not mention your name. So it's going to be private. So in terms of the market conditions, I'll start by perhaps stating the obvious. It's been a very challenging year across the board. Large cap stocks, mid cap stocks, small caps, international, you name it. Pretty much everything is down, anywhere between 15, maybe all the way to 30%, if you look at it from the perspective of each index. So that's that. What's interesting, the only sector that is up this year is energy, which is in some sense not all that surprising. And in the past, specifically over the past 10 years, if you look at some of those charts, actually one of the worst performance sectors. But year to date, it seems to be performing quite nicely. What is perhaps somewhat unknown, at least to some people at this point, is that domestic bonds are doing unusually poorly this year. As a category, they're down by almost 17%. There are different categories of bonds. You have short-term bonds that are down only by 3 to 4 percentage points. You have long-term bonds that are down by more than 20% year to date, but as a category, they're down by 17. In fact, this is the first time since the early 70s when both stocks and bonds are down simultaneously, and especially by such a large percentage. We'll talk about different reasons behind that, but one of the perhaps main reasons is this very aggressive Fed policy to fight inflation. As you can see in the middle of this slide, the 10-year Treasury yields, which are considered to be the benchmark for the market's interest rate. This is not so much the Fed rate, increased by more than 3 times since the beginning of the year. And that is a very rapid increase. With stocks and bonds, of course, they tend to adjust to that in real time, which, at least partially explains the decline this year. As I mentioned earlier, in terms of the sector performance, energy is the top sector this year. Utilities and consumer staples, they're actually in the positive in the first 2 quarters of the year to the most part. Then they decline, they're slightly in the negative at this point. And then consumer discretionary stocks and communication services or technology, it's a different name of calling them, are down between 30 to 45% year to date. And again, as a reminder, perhaps it's not going to be news to anyone who's been following the markets for the past, I'm going to say 2 to 3 years. The bottom sectors, they were leading the way in 2020 and 2021. So you see this, 180-degree rotation year to date. In terms of the market conditions, and again, focusing on what's been happening over the past couple of months at this point, not so much throughout the year. Well, how would you describe it? Well, we are seeing some signs of life. I mean, that's how I would be describing that. Specifically, last month or last October, we had one of the best months since the actually mid 70s. Most indices were up by more than 5 percentage points. And, there are multiple speculations why that was the case and exactly what changed since the third quarter of the year. But perhaps one of the most important ones is perhaps, inflation peaked. And we'll find out more about that actually tomorrow when we'll get our next CPI report. In terms of the sentiment, well, it's becoming more mixed versus negative, which was the case in the third quarter of the year. In terms of the market updates, there's always that immediate impact and how people digest it. But I will say that when the expectations are mostly negative and when the actual results turn out to be not as bad as many people expect them to be, the markets tend to rally. So perhaps that's what we've been experiencing over the past 40 days or so at this point. Inflation rates, and as challenging as it may be for many people to really see it that way, but at least quantitatively speaking, they're actually slowly moving down. And I'll show you a slide on that in just a moment. Of course, it's not where we would want it to be in terms of the expectations for next year, for 2023. There's really a very wide range, and the expectations for inflation by the end of next year range from anywhere between 2.5% in terms of CPI, all the way to 5.3, if I'm not mistaken. But most people, meaning economists and investment professionals, are expecting inflation to decline in 2023. Midterm elections. So I personally was hoping that there would be more to update everyone, as of this morning. Of course, I guess it's already in the afternoon, but there's not much clarity. So we'll make some comments later today. We'll likely see some market impacts, but with elections, politics in general, those impacts tend to be more in the short run, not so much in the long run. In terms of the earnings expectations, we're getting closer to the middle, excuse me, of the third quarter earnings season. So far, if you think of it from the big picture perspective, most companies are reporting, I'm going to say positive results, maybe not as positive as some people expecting them to be, with the exclusion of technology stocks. So positive with the exclusion of technology. In terms of the increases, it's only by 2% year over year. And for the fourth quarter, the estimates are more or less flat. So the point here is the expectations going forward, they're really not all that great. They are higher for 2023, and for full year, the estimates at this point are at 6.4%. Again, this is the overall earnings growth for the S&P 500. Now, one thing I tend to mention these are based on the guidance of different companies, and usually they tend to beat their own estimates. So there's that trick in place. In terms of the annual returns, and again, for those of you who know me, that's something I try to really stay away from as much as possible, because predicting performance results in the short run is very challenging, right? That's very challenging to say the least. But again, most people are positive. The estimates are anywhere between 8 to 17% for 2023. And in some sense, it's logical. Well, why is that logical? Because again, 2022, so far at least, has been a pretty bad year, let's just say it. So usually when that's the case, the following 12 months tend to be quite positive. And we'll also see more data on that in just a moment. In terms of the economic conditions, and that's I'm going to say in our client meeting specifically, that's one of the most challenging ideas to explain when someone is comparing where we are with the economy and where we are in the stock market. The economy is doing relatively well. I'm actually inclined to say it's doing really well from many perspectives, at least. If you look at it from the unemployment perspective at 3.7%, which is almost exactly where we were pre-pandemic at 3.5%. You look at the number of jobs still remain available, compare that to the number of people who are available to take those jobs, it remains at more or less the same level versus where we were earlier this year, roughly 2 to 1. It's actually 1.9 jobs available for every worker who is able to take those jobs. Now, for me personally, one of the biggest surprises was the GDP report for the third quarter. Turned out to be 2.6% in the positive, and that is again adjusted for inflation. So that is your real GDP growth. So in nominal terms, it would be more than 10 percentage points. Personally, I was expecting it to be, flattish, maybe in the slight negative and the slight positive, but 2.6% certainly tells you something about the state of the economy. Doesn't necessarily mean that this will continue. We'll see exactly how the Federal Reserve Bank, will impact that by raising rates. But at least as we speak today, the economy is doing quite well. And then finally, if you look at the consumer savings, and perhaps many of you know, in the U.S. this is a consumer-based economy. It's based on spending, not so much in savings. Earlier this year, the U.S. consumers had close to $2 trillion of savings. That figure is now at 1.1 trillion, and maybe that's one of the reasons actually why inflation has been so high, because again, people overall, at least, they have money and they've been spending it. So overall, again, the economy seems to be doing just fine as we speak about it today. So talking about the markets here, the chart you're looking at here is the asset class returns quilt. One of my favorite charts to review periodically. We actually do this internally. So for those of you who are, again, less familiar, what we're reporting here is the performance by asset class for each year from 2011 all the way to year to date on the right side, and then we average it for you in the very right column here. So year to date, and commodities are essentially the only category that is in the positive. Now, one thing I will specifically say, maybe it's obvious to some of you, it's mostly driven by energy prices. So when you look at a typical commodity index, it would consist of 10 or 11 major commodities, and oil and gas, major parts of that. So that's one of the main reasons. Not so much gold, not so much silver and other materials. They're actually not doing as great as, again, oil and energy. Cash and cash alternatives are in the positive. Well, as expected, the yields are much better at this point. Typical money market is yielding more than 3%, which is much better versus 6 to 10 months ago. And you can actually find some certificates of deposit that mature in 3 to 6 months, paying you more than 4 percentage points at this point. Domestic fixed income is down, as I mentioned earlier, and perhaps minor surprise here is that small cap stocks are actually the best performing equity asset class as of today. Not by much. We're only talking one percentage point or so versus other categories, but that just tells you something about at least some minor benefits of diversification. International and emerging markets are on the bottom, which is also logical given what's been happening outside of the US. The only comment I really make here, without analyzing this too much, again, for those of you who perhaps want to invest more in commodities and believe this is a good time, perhaps that's the case, and perhaps you should keep some in your portfolio. But notice that in the long run, again, commodities as a category are usually in the bottom. So keep that in mind. This is a very volatile asset class historically, and chances are that will continue. And that's not to say that, again, you shouldn't have any, but keep that in mind. Domestic stock performance. So this is where we spend a lot of time on this when we review our holdings, our own holdings, when we rebalance our portfolios, when we prepare recommendations for our clients. So on the right side, again, as a reference point, we're showing you the performance in 2021. So mostly positive across all different categories or styles, which is how people refer to them. On the left side, you see the year-to-date performance also by style. So you have large cap stocks, mid cap, small, then you have growth, core, and value. So the market was down by a little less than 19% by the end of last month. But hopefully one of the things you can clearly notice here is that most of those declines came from the growth side of the equation. And these are again your, Microsoft or Google, all of those types of companies, Peloton, Zoom. I'm just making examples here. I'm not saying they're, should be buying or should not be buying them. I'm just giving examples so you understand what those are. On the value side, it's very different. Value stocks are almost flat this year, down by 2.6% as a category, which all things considered is really not all that bad. Now, one thing I have to mention here, if you try to exclude energy from that category, value stocks will be down by more than that, by more than 2 percentage points, but still as a category, they're doing quite well. Energy, again, utilities, consumer staples, and real estate tend to be on that category. Core stocks are essentially the market performance, and healthcare and defense stocks are good examples of. Now, one of the questions we frequently get, if I have some extra cash, should I be investing that cash now? So there are multiple ways of answering that question. Of course, depends on your risk tolerance, your goals and objectives. Should you be doing it all at once, or should you stage it over a certain period of time? We can address all of that based on your personal circumstances. But one thing I want to make clear is that you don't actually have to invest in the market. You can always dissect it and overweight certain categories that make the most sense to you. As an example, if you're a long-term investor, you're not planning on taking any funds out of your portfolio for 10, 15, 20 years, then perhaps focusing on growth stocks makes more sense to you. Doesn't mean you go all in on growth, but perhaps you overweight growth-oriented holdings in your portfolio. Vice versa, let's say you're thinking about retirement 5, 7 years down the road, you want to take advantage of the markets, but you don't necessarily want to take too much risk. So again, let's say you have $100 to invest. Perhaps you overweight value-oriented investments and maybe stay more on the core side. Again, healthcare would be a good example of that. So you can really tailor it to your specific risk tolerance and your specific circumstances. You don't have to invest literally in the market. Inflation.
Alex, I'm going to interject for a moment. I'm going to launch the first poll. So if you are interested in CPE, please submit your response to the poll that's on the screen or in the chat box. I'll keep it open for about 30 seconds.
Sounds good. Gives me a nice opportunity to clear my throat. Okay, so inflation and what is behind it. So what we noticed in, I'm going to say several of our meetings is that, of course, everyone is aware that inflation is really high, but not that many people actually understand what's behind the CPI numbers. So we actually use this specific slide in some of our client meetings, and our clients found it to be quite helpful, so we thought we'll discuss it with you today. So what you're seeing here on the left side, this is essentially the breakdown of the consumer price index, or CPI. So one of the it's the largest block that you can clearly see there. It's called shelter. I actually prefer to refer to it as real estate and related services, which is a more common way of calling it. So it represents more than 30% of the CPI reading, specifically 32%. Now, why is this important? Is when the Federal Reserve Bank or the Fed is trying to raise rates to fight inflation. Well, one of the parts of CPI that they can directly impact is shelter, again, real estate and related services. How do they do that? Well, by raising the Fed rate, they make the mortgage rates higher. Mortgage rates are at 7% at this point. And as a result of that, for many people, it becomes less affordable to buy homes, right? So let's say if you're able to afford a house for $300,000 earlier this year, and the rate was at 3%, now it would be an equivalent of a $600,000 home. So for many people, it would not be affordable. And the actual statistic actually behind it, throughout this year, more than 24 million people are no longer able to afford to buy a home versus, again, earlier this year. And unfortunately, many of those people are first-time home buyers, by the way. So that's one of the ways they're doing that. Now, the rest of the CPI calculation, energy, food, and transportation are the next largest components. The Fed can only impact that indirectly. There are many other forces at play, natural forces or what's happening around the world, that the Fed cannot really do much about. There's a lot of anecdotal data to share. I mean, I'll say this: a lot of our clients want to travel. They've been they were stuck at home in 2020 and 2021. Now they want to catch up on their travel plans, and they're going to do that anyway, regardless of what inflation looks like. Is it 6, 7, or 8%? You have families, perhaps in the bottom quartile in terms of their income, and they have, say, multiple children. They have to spend a certain amount on food, so they're going to be doing that regardless. And of course, everything that's been happening around the world also has a lot of impact on that. Now, is inflation finally cooling down? Well, it's hard to say. I'm not necessarily ready to make that claim, but at least numerically speaking, it's been declining somewhat since the middle of this year. And again, as I mentioned earlier, perhaps one of the main reasons why in October the markets were so strong is perhaps, again, the markets are expecting that inflation already peaked. Again, we'll find out more tomorrow. Again, the markets remain data driven because, again, everyone is going to be paying attention to that. All right, so in terms of something that we've been really focusing on over the past, I'm going to say 6 months or so, but specifically over the past quarter. So for those of our clients who need or prefer to maintain a larger portion of their portfolio in bonds, there are many more opportunities at this point versus, again, earlier this year, or to be even more specific, versus the past 10 years or so. So what you're looking at here, this is it's called a yield curve, but we put it in a table format so it's easier for you to see. So certificates of deposit, domestic treasuries or U.S. treasuries, and different types of corporate bonds, including and also municipal bonds, now have yields of 4% or more. And again, you can clearly see that on this table. That is compared to less than 1% in many cases earlier this year. Now, if it's interesting what perhaps you already noticed here, if you go to the left and you look at certificates of deposit specifically that have shorter maturities, their yields are quite comparable. And if you go more to the right and you look at longer term bonds, they actually tend to be lower. That's an example of an inverted yield curve. Now, our strategy at this point, for those of our clients who need to keep more in fixed income, is to keep it short and focus on maturities of less than 2 years. If/when interest rates normalize, specifically when the Fed comes out and says that, look, we're done with raising rates, perhaps, again, the idea of building bond ladders will become more beneficial. So, buy bonds that mature in 1 year, 2, 3, 4, 5, and so on and so forth. But at this point, we're mostly focusing on short term. Market volatility. Again, is there any kind of light at the end of the tunnel? Well, the answer to that question is most likely positive, at least statistically speaking. So, you feel free to start this chart after this webinar, but I'll just summarize it for you. So again, historically speaking, on average, it takes 1.5 years or 19 months essentially for the markets to recover. We're in this so-called bear market territory. And when the losses are more than 22%, it actually takes 2.5 years for the markets to recover. Again, on average, so anywhere between 1.5 to 2.5 years. In practice, though, the actual range is much wider. For those of you who remember 2008, 2009, it took 4.5 years for the markets to fully recover, and then back to 20, 20, it only took 2.5 months. So again, the actual range is quite wide, but the average is anywhere between 1.5 to 2.5 years. Now, the recoveries tend to be quite rapid. So again, usually the following 12 months after the markets hit in a bear market territory, the average return has been almost 15 percentage points. And that is, again, another reason why it's so important, that golden rule, buy low and sell high. And for those of you who are not comfortable with that, and I understand that many people are really not comfortable with it, at least don't sell low. At least hold on to what you have and stick to your plan, because again, markets tend to recover quite rapidly. Midterm elections. And again, this is where I personally was hoping that would be able to share more with you. And on my right screen here, I have the live updates. And so far, it's more or less the same versus where we were 30 to 40 minutes ago. So it sounds like the two scenarios when we have a divided Congress or the Republicans win both chambers are the most likely scenarios at this point. And if you disagree with this assessment, I'm personally perfectly fine with that, because we'll find out hopefully soon. So if we focus mostly on the financial ideas behind those likely outcomes at this point, well, under the divided Congress scenario, well, more gridlock, less legislation. And interesting enough, for many people, that would not sound like such a great idea for our economy, for us, for the people essentially. But for financial markets, that tends to be a pretty good scenario. Financial markets or stock markets, they really don't like change all that much. They like this status quo scenario. Now, just like we experienced in the past, not too long ago, there's this increased risk of government shutdown. At some point, if that's the scenario, then perhaps at some point next summer, we'll begin to experience that, and usually you'll see more market volatility right around that time. Debt ceiling, that's that never-ending issue. And again, under this scenario, there's a higher probability there's going to be a fight around it, and especially when certain groups get involved. Now, under the second scenario, the one in the middle here, if the Republicans win both chambers, and my understanding, we're talking about 3 states at this point: Georgia, Arizona, and Nevada. That's for the Senate race. Well, perhaps we'll see more spending on defense. That is one of the likely outcomes of that. Perhaps there's going to be more support for the energy sector, specifically your legacy part of it, which is oil and gas. And that's actually important for many of our clients who actually accumulated significant percentages in the energy sector over the past year or so. Perhaps that would be one of those signs that, if you're planning on rebalancing, perhaps you should, but not as aggressively. Perhaps you would want to hold on to that part of your portfolio for longer. Now, under both of those scenarios, actually, there's a limited chance of fiscal support if, perhaps when, depending on where you're coming from, we have a recession. That's something I've been actually focusing on in my own readings, and that'll likely be the case. Now, how does that impact you personally? Well, perhaps keeping more in reserves would make more sense. Essentially, if you live off your portfolio income, perhaps again, the idea of having a larger buffer would make more sense for you. Again, we'll wait and see. And as I mentioned earlier, usually with politics in general, most of the impact is really in the short run, but I'll see what it actually shakes out to be, hopefully in a couple of days or so, or sooner.
Okay, Alex, I'm going to launch the second poll.
Please.
Please respond to the poll in the chat box or on the meeting screen if you're interested in CPE. Thank you.
No problem. All right, I see some questions here. Okay, so these questions, please keep asking those questions. We will be addressing them probably after the webinar. We have plenty of time, so we'll address all of them after the webinar.
Yeah.
All right, actually one more slide. Hopefully, many of you will find it to be quite curious. So I'm going to preface it very strongly. and say that with so-called data mining, and when you use data, you can data mine anything you want. I mean, almost literally. But in any case, we thought that this was a very curious chart. So what firms performed, the analysis they performed, and actually many other firms as well, they looked at many periods in the past during the midterm election year when the markets were down in double-digit percentages, so specifically when the markets were down by a lot. And what they discovered is that in the following 12 months post midterm election, there was a 0% chance, 0% chance of the markets being in the negative, which was quite surprising to us. We wanted to double check on this data. The average return, the average performance, essentially 1 year after the midterm decline, turned out to be 31.6%. Again, I will say this again, you can data mine anything you want. And usually when someone says, okay, there's a 37% chance, 53, and all of that sounds good as a talking point. But this was quite convincing. And even in general, again, when you have a negative year, usually when things shake out to be not as bad as people expect them to be, usually you expect a nice recovery. So again, to sum this up in terms of our top ideas at the end of the year, and again, not trying to disappoint anyone, but we cannot really talk about anything in specific here. If you have any questions, of course, feel free to reach out. But portfolio rebalancing and specifically capital loss harvesting, something that Debbie will talk about more a little later, this would be a perfect time to do that. The idea of buying low and selling high. And again, if you subscribe to that idea, then perhaps that would be a good time to do so. And we discussed earlier, what options you have. Again, it doesn't have to be your classic, I'm going to be selling my bonds and buying stocks or vice versa. You can also do it between different styles in your portfolio. So again, there are multiple options for buying low and selling high. We continue to overweight domestic large cap stocks pretty much in all of our managed portfolios. There are multiple reasons behind that. And, in terms of any kind of potential recession, it can be so-called soft landing, or perhaps we're going to see a more severe impact. Those types of companies have stronger cash flows versus other categories. So we do want to focus on them at this point. Now, dividend-paying stocks and specifically dividend aristocrats. That was one of our top ideas in the previous webinar, and I'm happy to report, it's always easy to say in retrospect, those types of securities performed quite nicely. They're down this year. Most of them are down this year as a category, but performed much better in many cases than core and specifically growth-oriented stocks. If you have an allocation in those types of investments, we'll continue to hold them perhaps. Be careful if you decide to add more, because if you're looking higher yields, perhaps you'll see more on the bond side, and specifically going forward, which is what I was talking about earlier. International stocks, we continue to underweight those types of categories for some of the obvious reasons. We try to stay in the US as much as possible at this point. Now, when we adjusted our allocations, we mostly focused on value-oriented international stocks. They have good yields. You're looking at 4 to 6, maybe even 5 to 7% at this point. So if that's what you're trying to accomplish, perhaps you should consider those. And then finally, fixed income investments, and specifically those of our clients who are in so-called bond-heavy portfolios. Be prepared, again, to readjust your bond allocation. And if it makes sense for your specific circumstances, be prepared to start building, again, so-called bond ladders. We're expecting these opportunities to present themselves anytime over the next 3 to 9 months. With that, Debbie, what do you have for us?
Well, thank you, Alex. That was excellent as always. I'm always amazed right now with the interest rates. I think everybody else is. It's just astonishing. 7% mortgages, being able to get 4% on a CD. I mean, we haven't seen this, since 2008. So for the last 14 years, we've been looking at virtually no interest and very, very short term, um, interest bearing situations because there was nothing to gain by going longer, right? And it was
That's
purely a
right.
buffer. That's how we've been referring to it. It's just a buffer. We couldn't earn any income on it. So times have really changed. So I'm just going to make a few comments today, not, going into any depth of any specific financial planning ideas, but really since we're close to the end of the year, just some timely reminders of things to be paying attention to. In terms of specific investment, or not investment, but financial planning topics, we're now doing separate seminars, really webinars on all different types of topics. We've done Social Security, Medicare planning, retirement planning, long-term care, college planning, planning for young professionals in different career stages. And we've really been doing a lot of those, probably over 50, I'd say at this point,
That's
since
right.
2020, besides tax planning and other accounting planning ideas. But you can see us actually on CBM CPA under YouTube if you want to go back and look at some of our uh, library of things that we've done, and we'll continue to do that. So I think as part of this market investment update, it will be just more highlighting what's timely and reminding you to look at certain things at that moment. So tax loss harvesting that Alex just mentioned, I want to say everyone should be looking at this at the end of the year. We've got about 6 weeks left. We've been talking earlier in the year about looking at it more in real time because the market was so volatile, but now we are at the end of the year. This is not a investment strategy. This is purely a tax strategy. And taxes are real, as we know, and we want to save taxes for most people. So if you have anything that's in a loss position, just because it is, at the end of the year in a taxable account, of course, this does not apply to retirement, you're going to probably want to sell that and you can reinvest it in something else. It has to be not the same thing within 30 days, but you can reinvest it, get it right back in the market, but you've harvested the loss and saving taxes on your tax return. So it's to me kind of a no-brainer, and we look at that for all of our clients' portfolio this time of year till the end of the year to take advantage of that. The second thing for people that are taking required minimum distributions or distributions out of their retirement accounts, and a lot of people are doing that towards the end of the year, especially when they're not necessarily living on that money, but they are, just trying to handle what's, the compliance that they have to do by the end of the year. This is a time to really think about, do I want to give some of that directly to charity? If you had a charitable intent, if you wanted to avoid, if you will, paying tax on the retirement distribution, you can do what's called a qualified charitable donation, QCD, and it has to be done directly from the distribution. It can't be that you get the check and then you mail you mail out the separate donation, because then that would not qualify for this. And the advantage really is it comes off the top. So you know that you're getting the tax benefit right off the top. For a lot of people, in terms of itemized deductions for charity, they're in the standard deduction. They're not necessarily getting the tax benefit that way. So this kind of guarantees, so to speak, that you're going to get that tax benefit. And we're happy to answer questions about any of this, obviously. So I'm going very fast over these points, but that's a year-end strategy as well. Then for those of you that are still working or have self-employed businesses, you want to make sure that you've actually maximized your pre-tax deductions. So that would mean obviously the most common one would be your 401k, your 403b. Make sure that you are actually going to hit the maximum that you're entitled to by the end of the year. And by the way, for next year, for those of us that are over 50, it's going up to $30,000 a year is the maximum. This year it's 27,000 a year. So that's just something to keep in mind to make sure you start off next year, maxing out everything early on. But that's just, again, once the year ends, you can't go back and sort of fix that. So that's one thing. And there's some other things that might be coming out of your paycheck that you have not maximized. It could be a health savings account. It could be a flex spending account. Could be something else that you were entitled to do pre-tax. And most employers will allow you to sort of catch up with the last couple of payrolls coming up to get you to where you need to be. So something to talk to human resources about, or something like that. With your self-employed, keep in mind that, you might have a SEP, self-employed retirement contribution. You have all the way until April 15th to contribute. But if you wanted to change that plan, maybe to a self-employed solo 401k plan, you can do that and be able to put more dollars into your retirement. Has to be set up by December 31st. Doesn't have to be fully funded, has to be set up. So that's something that has a deadline as well. The Roth conversion idea is, again, it's an end of the year situation of, do I want to take some of my current IRA that's in a taxable account, pay some tax on it, and now I have it in a Roth account that's growing tax-free. Obviously, there's a tax consequence where you would have to pay some tax. There's strategies to minimize or mitigate the tax on that, but it's something you should look at every year. And it doesn't have to be an all or nothing situation. It can be a calculation. So for example, if you're in a really low tax bracket, you might want to say, hey, this is a good time to take some of my IRA and convert it into a Roth. And you want to pay attention. People do end up in these sort of odd tax situations at the end of any particular year. And I've even had people that have had a no tax year, or that they've just not had taxable income that they had to pay tax on. It's like, this is a no-brainer. Let's take some IRA and convert it for free. So that's something else to look at. And then, of course, the catch-all, which is, review your overall financial plan. That's something I think people should do every year, maybe looking at a checklist. We could probably provide something if you wanted that. But that's really very all-inclusive of where you're thinking about, where do I want to head in 2023? Have I really been looking at my goals? Where am I? Have I done any kind of inventory of where I am? Of course, looking at your asset allocation and your investments, but also just, are you on track? And that's where you're maybe looking at your plans for the future. When are you going to retire? When are you going to claim Social Security? Do I still need all these insurances I have, or am I insured properly? I get that question all the time, because the policy renewals come out and you get that premium statement. And you're like, do I really need to keep renewing this? Does this make sense? Should I cash it in? All of those types of things I think should be looked at annually, just like an annual checkup. So those are really my comments for now on the financial planning side. I think we wanted to save some time. We've got about 14, 15 minutes to maybe go through the questions. Alex, that
That
Debbie, I'm
was
going to launch the third poll now.
okay?
So I'll keep this up for about 30 seconds for those of you who want to click on it for CPE.
sounds
Great.
good. So I suggest we start with the chat box. Obviously, those
Yep.
people are
Okay.
participating in the webinar. So again, please type your questions. We'll read them out loud, but we'll not mention your name. Okay, so here's the first one. Can you speak about pros and cons of individual bonds and bond funds? Absolutely. I mean, I'll give you a short answer here. With individual bonds, you can fully customize what is it that you're buying, and you know exactly when that bond matures. So as an example, if you buy a Microsoft bond that matures 2 years from now and pays you 3%, well, that's exactly what you're getting. You're paying, sometimes you can buy it at a discount. These days, you'll likely be buying it at a premium. And then in 2 years, you get your principal back, which is usually $1,000 per bond. Plus, you collect the interest up until the bond matures. With bond funds, essentially, you're investing in a portfolio of bonds. Usually, you're talking hundreds, in some cases, thousands of bonds. What are some of the advantages? Well, inherent diversification. And that's important, especially when you're focusing on bond types that have higher yields, so that none of them essentially goes bankrupt. And if one of them does, it doesn't have that much impact on your portfolio. Bond funds do not mature, and that's one of the difficult parts for many people to understand. But at the same time, when those individual bonds inside of the bond fund mature, they also they are reinvested at a better rate according to the fund's strategy. So that's that. You have customization here versus more of a universal and diversified approach.
Yeah, and Alex, would you also say, especially on longer term bonds, maybe more control in having the bonds holding to maturity
Absolutely. Well, that's with individual bonds specifically. If you buy them and let's say, mature 7 years from now, and if you're not planning on selling it, you're just planning on collecting the coupon payment, which is how they still call it sometimes, or interest payment, you're just going to get your principal back in 7 years. So you have full control over it versus, again, inside of the bond fund, when the managers of that fund essentially control what's happening with the bond holdings. So, all right, so that's the first question. The other one, very simple, which CD pays 4%? Well, many of them pay 4% at this point. So the way we purchase them, I know it's a technical detail. Schwab Institutional is our custodian. We can check it daily. We look at their inventory, and then we usually search by maturity. At this point, 3, 6, sometimes 9 months, and then we pick the CD that has the highest yield. That's essentially what we do. The best one we purchased so far had a yield of 4.25 and matures in, I'm going to say, in February. So that makes it, 3 or 4 months. We don't buy them from any individual bank. To answer your question, we buy it from the inventory that is available at our custodian. Okay, so we actually have several questions that were submitted to us prior to the webinar. I'll start with an easy one. Hopefully it's an easy one. Have Treasury interest rates peaked? Well, the answer is negative. That is quite unlikely. For those of you who either read or listened to Mr. Powell's remarks two weeks ago when rates went up by 0.75%, they've been pretty consistent. They'll continue to raise rates up until they see inflation moving in the right direction. It is possible that rates will not go up by 0.75% in the next meeting. My understanding, based on what I've been reading, perhaps we're looking at 0.5%, but chances are they'll continue to go up until, again, they come out and say so. Anything to add, Debbie? To that
No,
one?
I think that's absolutely right. I mean, one comment about 2023, which I think is interesting, that you were saying it's likely to be a positive year. At least all the stats have shown that for, going through a midterm election, been through a down year and all of that, is that it's not likely to be linear, which I think sometimes people think, oh, we're going to be on the upswing January 1st. I mean, it could be further down the first 2 quarters, and you may not see this more robust return of to the positive until the latter part of the year. We never know exactly when, but I think the thinking that you're saying is we're not out of the woods quite yet.
Yeah,
And
that's
when
a
second quarter, third quarter,
that's a fair assessment. I'll
yeah.
wait and see exactly how it all works out. Okay, so another, I'm going to say more of a technical question. Can you discuss use of TIPS? TIPS are Treasury Inflation Protected Securities in portfolio in this market environment. So it's, again, I would have to give you more of a technical answer, and I'll say this. Treasury Inflation Protected Securities, or TIPS, are long-term bonds. And as a result of that, they're negatively impacted by interest rates going up. And since our expectation is that they'll continue to go up for some time, we normally would not include them in our portfolios. Now, if you add a little more, the way the inflation adjustment actually works, the Treasury, they add to the principal value of the bond itself. That is actually how it works. So in the long run, if your concern is, above average inflation, the strategy will likely work for you reasonably well. In the short run, that is just not the case. And I confirmed before answering this question, TIPS are down by 18% this year. So that is your confirmation. So if your concern is, again, preservation of your capital, I would look at other options, not at Treasury Inflation Protected Securities. Longer question, more of a conceptual question. Some have suggested that the market has changed so drastically since early 2020 that we should alter our investments to be more aligned with the current financial situation and avoid the common pattern of 60% stocks and 40% bonds. Of course, no one pattern meets the needs of many or most clients. So my short answer is, well, absolutely. I mean, yeah, the market's at a very different point today versus where they were, 9 or 12 months ago. From our perspective, from our firm's perspective, 60/40 has never been our go-to to begin with. So-called balanced asset allocation. We always tailor it to our, client-specific needs, and we base our allocations on their specific cash needs. And we can talk about the bond ladders and everything. Now, if you dissect it a little bit, again, on the stock side, well, growth-oriented stocks specifically, many are selling at a pretty significant discount today versus other categories. It was the exact opposite of 12 months ago. So there is that opportunity. On the fixed income side, which was, I would say, one of the important points I was trying to deliver today, is that now, and perhaps 3-6 months from now, we'll be seeing many more opportunities to reposition and actually get good yields, 4, 5, 6, sometimes even 7%, if you're willing to dig deeper. So that's certainly a change versus, again, essentially decades, over the past decade, when bonds were there, as Debbie said, just as a buffer ballast in your portfolio. So I agree. Things are always changing.
Alex, I'm going to launch the final poll now for those of you who need CPE.
Sounds good. And then we actually have 2 more questions, and we'll be exactly on that 1 hour mark, unless we get more questions in the chat box. Okay, so this is another, I'm going to say more of a conceptual question. If your aim in this environment is to cash out some investments in a balanced, in this case, 50/50 portfolio to the tune of 300,000, what would be a smart way to do that? Or what considerations should inform your decision? Or would it be smarter not to cash out any investments, but rather enter into some kind of a loan? So I can imagine how different people would give you a different answer. I'll make some comments here. So 300,000 to me sounds like a significant sum. So usually for this type of expense, we would want to plan ahead of time. We would not want to be in the situation when we have a equity-based or balanced portfolio where we need to all of a sudden distribute $300,000 out of. So, but if that's the case, then I would start with the fixed income allocation of this portfolio. Do we have a ladder in place? Should we focus on selling bonds, again, to generate that cash that have shorter maturities and of higher quality? Because in many cases, they're not really down as much. So that's where I would start. I would really try to stay away from selling equities in this market for as long as possible. And if you decide to do that, if you absolutely must, at the very least, I would do it gradually. Now, the second part of the question, should you consider getting some kind of loan? Absolutely. Margin loan is one of the options. And well, yes, at this point, they're not as advantageous as they used to be 9 to 12 months ago. At this point, you'll get a margin loan for anywhere between 5 to 7%. But if this is a short-term cash need, I'm not exactly sure the purpose for this distribution, then that's perhaps a good way to go, so that the funds you have more time to recover, or perhaps a combination of the two. So that would be my comment. Debbie?
Yeah, and sometimes people have home equity lines of credit. I mean, to Alex's point, when we are trying to plan for people for the potential of needing money, we set up these things in advance. We make sure they have access to margin loan, maybe home equity line of credit. Maybe they could even borrow from their own 401k. Maybe we would look at liquidations that while we're doing some, some other rebalancing perhaps. But, you have to look at, sometimes people, even in a down market, still have capital gains to pay. The
Yeah.
market has gone way down, but they bought it so long ago, there's still a capital gains tax. So you'd have to take a look at that as well and see what is the tax motivation, what's the market situation, what's the cost. The interest is always pros and cons to everything. So it's a difficult, one size fits all question.
Absolutely. Yeah. So final question. It's also a quick one. This is we've been getting this question in every single webinar this year. Thoughts on I bonds? they all of a sudden became one of the most popular types of investments out there. So make it very clear, we're neutral on I bonds. And the reason that's the case, and I'll kind of jump to the conclusion here, many people misunderstand that the yield on I bonds adjusts every 6 months based on inflation at the time. So at this point, it's 5.6%. 6 months ago was 9.6. So if slash when inflation begins to decline, and let's say we hit 2, 3, maybe 4%, those bonds are not going to be yielding you all that much. And that's important because, again, people believe that if they buy it at 5.6 or some kind of rate of that nature, and they hold the bond to maturity, that's what it's going to pay. That is not the case. It will adjust, and again, if inflation begins to decline, it will be paying you less than that. There are other issues too, but that's one of the main reasons why we're neutral on I bonds. Well, and with that, we're exactly at 1 hour mark. I'll just say that
exactly.
perfect timing. We have quite a few events this year, actually, in November and December and the beginning of January. We'll be talking about some of the most important considerations for those in their pre and post retirement years. Actually, what is it, next week or 2 weeks from now? We'll have multiple webinars on year-end tax planning with the market update, but a real focus on tax planning. We'll talk about Medicare inflation and the Inflation Reduction Act in the middle of December, December 15th, and then on January 10th, actually one of our most popular webinars, we'll talk about Social Security and maximizing your benefits, and of course, avoiding some of the most common mistakes. So again, that's all on the financial planning side. Again, if you have any other questions, feel free to reach out to any of us directly. Here's our contact information. And again, thank you for participating in our webinars. We appreciate it.
Yes. Thank you, everyone, and best wishes for the holidays.
Absolutely. Happy holidays.